We've also seen the Treasury announce a significant further ramp up in issuance, and where on the yield curve ultimately that's going to set. And we've obviously for the last decade seen very little correlation between supply and yields right now. Do you see Q1 and the explosion of supply that we saw and the sort of rally, the ramp up in yields as an anomaly, a coincidence, or do you think that correlation has changed as we push throughout the year?
No, I think it should be correlated. I don't see it exactly in terms of what investors anticipate from the standpoint of supply. I mean, we know, for instance, that the Fed is undergoing quantitative tightening, perhaps taking or adding 30 or 40 billion to the market for other outside investors to buy. We know that the Treasury itself, is adding to 2s and 5s and 10s and 30s, probably at $1 billion, an auction. Is that significant? Well, it's certainly different. And we know it may even go higher based upon the potential deficits going forward. So in my view, supply from the Treasury is a factor in addition to what the Fed might do in terms of a mild bearish tone for U.S. bonds, U.S. Treasury bonds. I would expect the 10-year, for instance, now at, 295, to basically meander around 280 to perhaps 310 or 315 for the balance of the year, but not much of a change. It's a hibernating bear market, which means that the bear is awake but not really growling.